Oh yeah, I forgot. Just a disclaimer before I start. This is not financial advice. It's only for education purpose only. So please do your own research before you make any decisions.
All right. Hi, everybody. My name is Richard.Lesperance. I go by the name of my man Richard. Welcome to A Better Lifestyle. Today, I have the pleasure to have Fadi Habib with me. Fadi is doing some great work in the financial industry. So I think you guys are going to benefit from that episode because we're going to be talking about option investing. So welcome, Fadi, to the podcast.
Welcome, Richard. Happy to be here.
Great, it's my pleasure. So tell us a little bit about yourself. How did you get started in option investing?
So my story briefly is that I am an engineer. All of my life, I did what I was supposed to do, like get good grades, get a good job. I've always had a good job, worked for 25 years in the oil field industry, manufacturing, supply chain, high tech. I used to work in BlackBerry. And all of my life, I had a good job, but I'm always tight in money. I can't do everything I want to do in terms of traveling and buying a nice car. I read this book, Cash Flow Quadrant, and I learned that if you want to amass any kind of wealth, you cannot just rely on the 9 to 5. The Cash Flow Quadrant by Robert Kiyosaki, I suggest that your listeners read that book. Says that there are 4 ways to make money. Employee is the first quadrant that everybody starts with. And then if you want to have a little bit more, you should go and be either self-employed, that's number 2, third, business owner, fourth, investor. And I started teaching myself about investment. So like 9 to 5, I used to do my work really good. And then 5 to 12, I used to work really hard on myself, learning. I started learning first about real estate investing. And I did very well. And at that time, I thought that investing in stocks and options are for really irresponsible investors, because everybody around me was losing money in the stock market, and everybody's using it as a casino. Like everybody they're buying lottery ticket, they're not buying stocks. So I went to this course basically to prove to myself that I'm right and that investing in stocks is a gamble. And I was pleasantly surprised. There is a way to invest in stocks if you understand. The problem is nobody teaches people what is the stock market, how do they look at stocks, what is a good stock, what is a good company. Stocks are not lottery tickets. Richard, stocks are businesses. We're buying businesses. And the way to evaluate a business is mainly one thing. Are they making money or not? A business cannot be labeled as good business if they're not making money. I don't care if the products are really sexy and good. If they're not able to make profit, then they're not a good business. For me, it's not investable. So out of the 6,000 companies in the stock market, I think 1% is investable. All what you need is 10 to 15. So if you know how to evaluate stocks, basically, if you want to go and buy a rental property, anybody will ask, what is the rent? What is the expenses? Is it cash flowing? What is the cap rate? Is it in good location? Because you're evaluating the business. You're not just evaluating the colors of the thing. If you want to buy a refrigerator, people spend hours to figure out what is the best refrigerator. But when it comes to the stock market, for some reason, Richard, they don't do any of that. They just go and buy thinking it's a lottery and they're going to buy it today and will go up tomorrow. So anyway, 10, 12 years ago, I started that. And then did very good. So they got me to coach people. And then basically 6 months to a year ago, I started my own company called Legacy Wealth Builder Academy to teach people. I have a 12-week mentorship program whereby I teach people how to do it responsibly and profitably.
Okay. How does the mechanic, like the whole game of option investing, works compared to someone who's investing in the stock market?
Correct. Options are really powerful in terms of getting better returns, but also it has higher risk. So you have to know what you're doing. You cannot just go and try it out. And what I teach people is that you have to start, all my students, they have to start with something called a paper account. Paper account means it's free to open. When you go to a brokerage like IBKR, for example, you can open a paper account. they give you $1 million monopoly money. So you try investing in this paper account. If you made money, you don't take the money. And if you lose money, it's not your money. So basically, they give you, it's basically like a training account whereby it's zero risk for you. That's the right way of doing it. So options comes from the word option. Basically, instead of you buying the stock, you go into a contract with somebody else, and whether you or the other person, dependent on who buys the option versus sells the option, the guy who buys the option will have the right to exercise the option at some point. What does this mean? I'll give you an example. Let's say you have a stock called XYZ and you bought it at $200, and you are so afraid that it will go down below 190. So you come to me and say, Fadi, I know that you collect XYZ. You buy XYZ, you think it's a good company and you want to buy it. I know that you want to buy it at 200. You were thinking of buying it. That's correct. I want to buy XYZ at 200. Let's have an agreement between you and me. If the stock goes down to below 190, can you buy it from me at 190? For me, as Fadi, I wanted to buy the stock at 200. For me, buying it at 190 is even a better deal. And if I go into this kind of insurance contract with you, because you really are buying insurance, the insurance that you're buying is that if the stock goes down below 190, you have somebody else to buy it from you at 190. If we go into this options contract, you tell me, Fadi, I'll give you $5. And I say, this is a really sweet deal. I wanted to buy the stock at 200. Now I will have the chance to buy it at 190. And if just because I agreed to buy it, I didn't buy it yet, you'll give me $5. So really, if I get to buy it, I'll buy it at 185. So this is just one type of option whereby it's like insurance. I have insurance. I paid insurance for the last 20 years, 30 years for my car. Didn't really go into a lot of accidents. The insurance company made tons of money. So here it's the same thing. I'm the seller of the option because I agreed with you that if the price of the stock goes down to 190, I will buy it from you. You bought the option. So you bought insurance that if it went down below 190, somebody else will buy it from you. So that's an option. Bottom line is the option will give somebody the right to exercise something and somebody else the obligation to do it. In this example here, you are the buyer of the option. You have the right to exercise the stocks to me, or basically force me to buy it from you if it goes below 190. And I have the obligation as the seller of the option to buy it from you when you tell me, Fadi, I want you to buy it at 190. Basically same idea as the insurance. I go to the insurance company, I tell them I want to buy insurance from you so that when I get involved in an accident, you have to buy the car from me at today's price. Right? Let's say I had an accident with the car and it's totally wrecked. They will pay me the price of the car before it's wrecked, right? So it's the same idea. The main point here is that we only do this. I only insure stocks that are really good. Basically, stocks that are making earnings, they don't have debt, and they have a good competitive advantage because I don't want to insure bad stocks. So the bottom line is it's something that you can make. My method makes about double. The market makes about 11% every year. Like if you buy the SPY, which is the ETF, around 11% for the last 50 or 100 years. This way you can make 24%. And it's a very nice way of balancing ROI and risk. Because one of the myths that everybody in the stock market sometimes don't think of is that if you have a strategy or something that has huge amount of ROI, it means also there is a huge amount of risk. So I don't want things, you get all these ads all the time about you're going to double your money in 2 months, stuff like that. That's get rich quick scheme. I don't do any of that because that's not really sustainable and it's not consistent. 24% is consistent. That's the average I see around people. And the worst case scenario is that I'm going to buy a stock that I want to buy it at a discounted price. So it's a very, very good way. Most of the people I teach are doing both stocks and options.
So how does someone go about using that vehicle to build wealth?
Okay. So in this example that I just told you, the premium is about 2-3% per month. Okay. This translates to 24% to 36% ROI per year. Which means that if you have $100,000, you will get something like 24,000 or 36,000 by the end of the year. So at 24%, you'll double your money every 3 years. There's a rule called the rule of 72. If you divide 72, divide by the ROI, it will tell you how many years do you need to double your money. So people use that in two different ways. Number one, wealth building. So if you want to like basically capitalize and like increase your wealth, basically on average, you will double your money every 3 years, okay, with 24%. Not every year you get 24%, like, you know, if there's COVID, it's go down, but overall, on average, on a long term, it will be 24%. So that's one way of doing it. The other way is income generation. In this example that we talked about, I got paid $5. That's income. Okay, it's around 2% per month on average, again. So two ways of doing this. If you're focused on wealth building, basically you leave the money in to compound, then you expect to double every 3 years on average. But if you want income generation, you'll get something like 24% again on average. So it can be used either or.
So is it a little bit comparable to day trading, or it has nothing to do with day trading?
So it is the way I teach it. Some people use option in day trading, which is like, for me, day trading is very, very risky. A lot of the ads that people tell you about day trading, that they doubled their money, they gained 100,000, you should be asking them how many accounts they blew up. They usually share the good stuff. They don't share what they lost. So day trading, number one, is very risky. Number two, takes tremendous amount of time and skill. Okay, this is very, like, there are different types of investing, Richard. One is long-term investing, like the Warren Buffett style. You buy something and you leave it for 25 years. And there's swing trading, where you go in and out in about like a week to a month or 3 months. There's day trading, which is you need to go and in and out every day. And there's scalping. That's the extreme way of day trading, where you go in and out. I used to do that at some point. And it's basically you go in and out in 3 seconds. The more you go on this way to the scalping, the more you need extreme amount of skill and extreme amount of time. Okay, day trading and scalping, you need to be in front of the computer all day, looking at charts and stuff. What I do is not that at all. I don't do day trading. We do a little bit of swing, but the focus is long term. So all what I need is, after I learn the method, is just 10-15 minutes a day to just manage my transactions. But it is very like low key. It does not need a lot of adrenaline. We don't care about the market goes up or down a little bit, like, because the worst case scenario, we're going to buy a stock that we want to buy. So it's not day trading at all. I don't believe that day trading is a vehicle that can make money for the masses. It needs special type of people who have, like, you can't have for example, you can't have a full-time job and be good at day trading, because it needs tremendous amount of looking at the chart and reacting to the chart. What I do has nothing to do with that. It's much more laid back, and it has really good return compared to the fact that you only give 10-15% a day, minutes a day.
So who is it for, that type of investing?
That type of investing for anybody who knows that they have to invest, that they cannot just rely on the 9 to 5. It is not for somebody who thinks it's a get rich quick scheme, or have this mentality of, I like to gamble. So we don't go buy a stock unless we know it's a good stock, which means you need a bit of research. You need to know what you need to look for. And it's not really tedious research, because there's some automated screeners right now that you can go and figure out what is a good stock in terms of who is making money. Like, there's a big difference, for example, between Apple, that is making like $90 billion a year in cash, in profit, versus BlackBerry, that they're losing money, right? They're both companies that big brand, but one is very investable, one is not investable at all. And it needs 20 seconds to look at the income statement so that you can see there's a big difference in terms of one has profit, one doesn't. So it's for somebody who wants to take it in a little bit more of a scientific way, somebody who's busy, like has a 9 to 5, and somebody who wants a methodology to do things, not just go in and out thinking or hoping that the market will go double tomorrow, because it doesn't really, they can't rely on this on a long-term investment thing.
In regards to someone educating themselves in that field, how many hours or how long do you think someone should invest before they start?
Okay, so this depends from one person to the other. The main thing here is this, is that in options, there's so many ways you can use options. Some of them are very risky, some of them are not that risky. Risk mitigation is very important. So the information about how to do options is free. It's on the internet. You can go to YouTube and learn it to yourself, because information is commoditized right now. Like it's there. The main point is not how much time. The main point is that you open an IBKR paper account. It's free, and whatever you learn, you need to try it for 3-4 months. If you're making money in the 3-4 months, then you can start thinking of putting money by yourself. So one way of doing it for free, like learning, there's also people like me who offer courses and offer mentorship programs. And the idea with this mentorship programs is that it reduces the amount of time. You need somebody not just to teach you, but also to give you feedback. So for example, in my mentorship program, it's a group mentorship program. So there are 5-6 people in the room. They share their screens. It's a paper trading account, so there's nothing confidential. And we go through the trades of everybody and we discuss it and ask questions. And this feedback helps people a lot. So learn, whether it's free or join a program, open a paper trading account so that you don't risk your own money. And then you have to try the strategy that you learned in the paper trading account. If you're not making money in a paper trading account, you have no business going and putting your own money. So if you don't make money in the paper account, it means that either whoever taught you or whatever strategy you learned is not right or doesn't work for every situation. Maybe you're making mistakes. Maybe you don't understand something, but the arena whereby you debug all this stuff till you dial it and you make money is the paper trading account. If you do it with your own money, you're going to lose money for sure. So you do all the mistakes, you learn with paper trading account. That's the responsible way of doing it. And then you go and you put your own money once you dialed it in and know that it's working.
So in regards to that, how much the startup capital you think
Is needed.
is needed?
Okay. So with options, in stocks, you can buy one stock. In options, the minimum, basically, it's contracts. And a contract is 100 stocks. So you have to have money to buy 100 stocks. So if you go something that is maybe like $50, I don't know, Coca-Cola, maybe 60, then you need, the minimum is about $5,000. I recommend $10,000 because you need to have the money. You don't need to buy the stock, but if the price of the stock went down, you have to buy it. So I would say between 5 to 10K is the starting point there.
Something like maybe if people when they're doing the study, they might find out, I don't know, correct me if I'm wrong. Is there an option people to use margin?
Yes.
I know that's very dangerous, so that's why I'm
Yeah. So let me go one step back. More important, Richard, than learning how to make money is learning how to not lose your money. Okay. For me, this is 3 times more important. Like same as Warren Buffett said, don't lose your money. That's the first rule. Second rule, don't forget rule number 1. So learning how to drive a car is easy. Any fool can do it. You just need to push the gas pedal and the car will move. The whole game about driving a car is not to be involved in an accident. Okay. So if you spend 1 hour learning about a strategy to make money, you need to spend 3 to 4 hours how to not lose money. So you need to learn how people in your shoes lost their money. One really nice way to lose money is to use margin. Just to explain to people what is margin, when you open an IPKR account and you put $10 there, they will allow you to buy stuff with 33, sometimes 50. So they will lend you money like 2-3 times the amount of money you've put. That's called margin. It's like, again, giving you a mortgage. When you go buy a house, you can put 25%, like a house is $100,000. Let's say, for example, you can put 25,000 and take a mortgage for 75. In stocks, this is extremely dangerous to do. I know it's a quick way to make, instead of making $1 profit, you can make 3 at the same time. However, it is very dangerous. There's a big difference. I will never buy real estate without margin, without going to take a mortgage. But I will never do that with stocks. Why? Because stocks are much more volatile than real estate. The problem with margin, Richard, and thank you for the question, is that if you use margin and the market goes down, and it goes down, we know it goes down like 20% once every 1.5 years. It goes down 3 times 5% every year. One time 10%. It goes down by 30% once every 2-3 years. So we know it goes down because the market, the normal behavior of a market is that it goes up and then down, up and then down. Overall, it's going up, but it breathes, inhales and exhales. So because we know that sometimes it can go down by 20 and 30%, if you are in margin, you are in a huge, actually, I have a real case study of someone in Vancouver who actually lost all of his money. He used to love to invest in Nvidia. This is a true story, Richard. He used to love investing in Nvidia. He had all of his life savings, $100,000. So he chose a good company, Nvidia. He went at the right time. The problem here is that he did not buy Nvidia with 100,000. He used 330, all of his margin. And in COVID, it went down by 40%, and he wiped all of his money because the brokerage, though they lend you the money, they're not your partner. They're not your friend. They will not lose money on your behalf. So they will liquidate you. They will take all of your money. They will sell positions. So it's very, very simple. Yes, there is margin. Do not use margin. If you put $10, you buy stuff or you sell puts just for the $10. If you put 100,000, you don't go and use the 330. Use only 100. So never use margin. That's one of my hard rules. Never use margin.
What are some mistakes that you made?
I made a lot of mistakes. First one. Okay, now it's confession time. Okay. I used margin at some point. And I used margin because I was novice and I did not know. So the problem here, Richard, is that when you are on a streak of winning, like I remember one of the transactions I made, I got $50,000 profit from it. And I thought I'm the king of the world. Because when you don't know what you don't know, you think you're invincible. I was so lucky. Knowing what I know right now, I will never do this transaction again. Because if the market went down while I'm holding this transaction, I would have big portion of my portfolio would have been wiped. I was lucky. I saw other people losing money and I corrected. So the game is not how to make the most money possible. That's a sure way of losing all your money. Same idea as somebody telling you, listen, if you win a lottery, you're going to win $50 million. Please go invest and buy with all of your money lottery tickets. It's a really stupid way. I'm just taking it to the extreme because you can't just look at the ROI. You need to look at the risk as well, right? If you buy with all your money lottery tickets or even one ticket, the chances of you losing all of your money that you paid in one ticket is humongous, right? Because like the chances of you winning this transaction is almost zero. It doesn't change a lot if you buy a ticket or not. So my first mistake is I used to have margin at some point of time. And this happened because like for a year or two, I was like winning. And I didn't really, that's the second mistake. I didn't really look at the psychology of things. Psychology is very important. You can teach two people exactly the same things. One will go do very well. One will do nothing with it. One will do it horribly. So if I don't know that this is a mistake that people go into thinking they are invincible and that they know everything, you make that mistake. So first mistake is that I used to do margin at some point. I was young and stupid. I corrected that. The second mistake I do is that sometimes when the market, I didn't understand at the beginning that the market goes up and down. That's normal. Most people that are not trained will be very panicky when the market goes down. They don't, it's as if your child started inhaling and then exhaling, and you think that by exhaling that there's something wrong, and you think you need to get a doctor for your child. No, it's normal. So, for example, when people ask me about these tariffs, the market has been going up for 2 years. It was time for correction. Whether it was the tariffs or something else, the market would have found something else to go down. So that's another mistake I did, is that before I used to be a little bit upset that the market goes down. No, for me right now, it's very simple. if the market goes down and I know that the company is a good stock, it's time to buy more. For example, Meta, at some point it was $400 and then it went to 80 within a year. Okay, people who don't understand that Meta is a good stock started selling. The normal behavior of a person who doesn't understand, that's why a lot of people lose money, is that they will buy at the most expensive point. They will wait for the stock to go really up and then will buy it thinking it's going to go up. And then when it goes down, they panic and they sell it at the lowest possible point. That's why everybody is losing, because they have no conviction that this is a good stock. They don't understand the behavior of a good stock. Good stock on a short term can go down, up and down, sideways. There's no correlation at all. Peter Lynch told us that. There's no correlation in the short term, and short term is 2 years in the stock market. There's absolutely no correlation between the price of the stock and the value of the stock. So company can be really good and the stock price is going down. Company can be really bad, losing money, and the price of the stock goes up. However, on the long term, and this is what we capitalize on the long term, the value of the stock and the price of the stock has 100% correlation. What does this mean? It means a good stock like Meta, even if it went down to 80, because it's a good stock, meaning having earnings, it went down because of COVID. Anyway, has nothing to do with the sales of Meta. If you hold to it, it will go up again. So Meta right now is went up, approached $700. Why? Because it's a good company, makes a lot of earnings, lots of profit. It's not very easy to replace Meta. So not understanding the psychology and how you deal with things, if you left to your instinct, is really bad in the stock market for some reason. Like I always tell people, if you go and buy apples and you know it's $10 a kilo, and then tomorrow you went to the store and you found it to be $5, will you panic? Will you go to your house, get the apples that you have and sell it with $5? No, it's time to buy more, right? If you know that the apples are good and taste good, and you know that the price is 10, if it went down to 5, the prudent investors, the people who know what they're doing, they don't panic. They think it's a time to buy more if it is a good stock. If it is good, you don't just buy any cheap stock. You have to buy only good stocks.
What are some great places that people can learn more about option investing?
So you can go to YouTube, search for it. Number 2, you can also go to my website, Legacy Wealth Builder Academy. My LinkedIn, I put a lot of content as well. Fadi Habib is my name, FADIHABIB. So YouTube, there's so many free stuff. And again, if you want to follow me, Fadi Habib on LinkedIn and legacywealthbuilderacademy.com.
Okay. Any other places people can follow you, or those are the main ones? So
there's, again, if you look at Legacy Wealth Builder Academy on Facebook, you can search for me on Fadi Habib, or you can email me at info@legacywealthbuilderacademy.com and I'll send you all the socials.